John Keells Holdings, JKA, just dropped some absolutely mind-blowing numbers. We're talking a massive profit boom. But, and this is a big but, that headline number doesn't tell the whole story. Not even close. So let's get into it.
And here it is, that number, profit before tax, up an incredible 427% year over year. Now, to put that in perspective, their revenue only grew by 77%. So you can see profit growth is just leaving revenue growth in the dust. On the surface, this looks absolutely amazing, right?
Okay, but here's the catch, and it's a big one. If you're a shareholder in the parent company, JKH, you only saw about 17% of that massive profit explosion. A whopping 83% of it, well, it went somewhere else. So the big question is, where did all that cash actually go? All right, before we dig any deeper, just the standard heads up. This is purely for educational purposes. It is not financial advice. Please always do your own homework.
Okay, so first things first, let's give credit where it's due. We got to look at the company's profitability engine, because from an operations standpoint, wow, they are just firing on all cylinders.
Check this out. Revenue on the top line shot up to almost 259 billion rupees, and their efficiency, it's just off the charts. Their operating margin tripled to 6.1%. That tells you they have incredible operating leverage, and they're keeping a really tight grip on costs. They're absolutely running a much tighter ship these days. So, it all sounds amazing, doesn't it? Great revenue, margins are through the roof, but like I said before, and you've probably guessed it by now, there's a pretty big catch.
And that brings us to the first major piece of the puzzle, the partner share. This is where we start to see where all that money is really going.
Okay, brace yourself for this number. The profit that went to what they call non-controlling interests, which is just a fancy way of saying JK's joint venture partners, it didn't just go up, it surged by over 7,000%. No, that is not a typo, 7,115%.
So here's what that split looks like. A huge 83% slice of that profit boom went straight to the partners. That left just 17% for the parent company's shareholders. So yeah, the profit is definitely real, but it's just not ending up in the pockets of JKH investors.
So, you're probably asking, why? Why is this happening? Well, it's all because the company's shiny new growth engine is its automotive joint venture. That single part of the business now makes up a massive 56% of the group's core earnings. But here's the kicker. JKO only owns half of it, so they have to split all those juicy profits right down the middle. Now, on a brighter note, their City of Dreams casino venture is starting to turn things around. Losses there have been cut in half, which is great news. It means they've finally stopped the bleeding over there. All right, so now we get the profit split. Let's switch gears and move away from the income statement over to the balance sheet. Because, there's a bit of a hidden risk that's been building up right here. Whoa, just look at that spike. In only 6 months, the value of inventory on their books has ballooned by 16.6 billion rupees. So what's going on? Well, they're stocking up big time, mostly on vehicles for that new auto JV we were just talking about. That is a huge amount of cash that's now tied up in cars just sitting there, waiting to be sold. And as you'd expect, building up all that inventory has a direct and pretty serious impact on the company's liquidity. Their quick ratio, it's now dropped to 0.81. And let me tell you, that is a really critical number for any company. So what exactly is the quick ratio? Think of it this way. It's a quick test to see if you can pay all your immediate bills with the cash you can get your hands on fast. And here's the key part, without having to sell your inventory. So when this number dips below 1, like it has here for JKH, it's a warning sign. It means their most liquid assets no longer cover their short-term debts. They're making a big bet that they can sell those cars, and sell them fast, to make ends meet. And this is where it all comes together. This leads us to the real heart of the story, this massive disconnect between that amazing headline profit and the actual real cash flowing into the business. Just look at this. On one side, you've got that spectacular 427% profit growth. But on the other side, you have the cold, hard cash reality. Operating cash flow didn't go up. It actually went down by 6.6%. Just let that sink in for a second. The company is making way more profit, but it has less cash coming in from its operations. And believe it or not, it actually gets worse. When you factor in capital expenditures, the money they have to spend just to maintain and grow the business, the company ends up with a negative free cash flow of 3.24 billion rupees. This is the bottom line, folks. They are literally burning through cash to get this headline growth.
So if they're burning cash, how are they paying the bills? Well, here's how. They paid down about 24.5 billion of their stable long-term debt, but then they turned around and borrowed almost the same amount, nearly 24 billion, in much riskier short-term debt. What they've done is they've traded long-term stability for short-term pressure. And that seriously ramps up their risk if they need to refinance that debt down the line.
Okay, so we've looked at the profit, we've looked at the risks, we've looked at the cash. What's the final verdict? Where does this leave JKS at this really pivotal moment?
It really boils down to three key things. First, the revenue growth is legit and the company is being run well. No doubt about that. Second, the company is burning through cash right now, mainly because of that huge pile of inventory. And third, and maybe most importantly for investors, it's the partners, not the parent company shareholders, who are walking away with most of the profits.
Look, JKH has essentially pushed all its chips in on two big high-stakes bets, that Auto JV and the City of Dreams Casino. And what that means is that the entire investment case for this company, from this point forward, comes down to just one single word: execution.
And that leaves us with a big question looking forward, right? Can the management team actually turn these giant ventures from cash-burning machines into cash-generating machines over the next year, year and a half? That really is the billion-rupee question.
So the next time you see a company post a huge, flashy profit number, I want you to remember this story. The lesson here is crystal clear. Ignore the headline profit. Watch the cash flow. Because that's where you'll always find the real story.